Good morning. Welcome to our webinar, where we will be discussing MiFID II, which, for those of you who haven't looked up this little bit of jargon, stands for the Revised Markets in Financial Instruments Directive. This is the first of a series of finance webinars that we'll be holding throughout 2018 to help our members become more aware and familiarised with a number of issues in the finance sector that will affect finance companies in the UK. MiFID II has been part of a big discussion in the past few months as we've been running up to the 3rd of January when it will start in practice. So we're lucky today to have Consilium and Covington here to explain it to you and help you prepare for its introduction in January and give you practical advice on what you want to do. My name is Martin Turner. I'll be chairing today's discussion. I look after finance policy at the BIA. We started the conversation about MiFID II for the past few months, including talking to the Financial Conduct of Treasury about its introduction, how it could impact on the biotech sector. So if you haven't heard of MiFID II, not to worry, we've got two great experts here today. We have Fennell from Consilium, who is partner and co-founder, and we have Charlotte Hill, partner at Covington. I'll do housekeeping rules. We're all on mute at the moment to prevent any background noise, and the webinar will be recorded and put onto YouTube shortly after, where you'll be able to view it. Use the chat box throughout the webinar to ask questions, but we'll be putting them to our speakers at the end. So without further ado, I'll pass over to Charlotte to start our discussion today.
Thank you very much, Martin. My name's Charlotte Hill, and I'm a partner at Klein and Burling, which is an international law firm. And we're doing a lot at the moment on MiFID II, as it's something which is affecting firms throughout the world, even though it's an EU directive. So what is it? Just a moment, that's right. So what is it? It's, as Martin said, it's the Markets in Financial Instruments Directive. It consists of both a directive and a regulation being called MiFIR, the Markets in Financial Instruments Regulation. That's important because the regulation has to be simply cut and pasted in UK law. There's very little room for manoeuvre there, whereas we have more room for interpretation when we implement the directive part of it. What it's for is new regulations form the legal framework governing the requirements applicable to investment firms, trading venues, data reporting service providers, third country firms providing investment services or activities in the EU. So it is incredibly broad, its coverage and what it applies to. The scope and objectives of MiFID II. One of the main objectives of it is increased consumer protection, and that is emphasised a good deal. The increased transparency of markets, a shift in trading towards more structured marketplaces, and a feeling that in the past, the predecessor regulation has not kept pace with innovative new developments and the way in which the market is developing and new markets which are developing. So new regulations coming in to catch entities that were not previously caught. So market data is another objective of MiFID II. Improve best execution, new ways of putting things into the best execution policy, new coverage. The authorities found at the time when the requirement for best execution policy came in, it was fine, but they found nobody really took too much notice of it, and it wasn't quite doing what it's supposed to do. So new requirements there. We want to make sure that there's orderly trading behaviour within markets, and also making the costs more explicit. So lots of new rules on the disclosure of key changes here. A new type of trading venue within the regulatory framework has been created, and that is the organised trading facility. And that's a multilateral discretionary trading platform. It's not currently regulated, so that is brought into the fold. So these rules will catch trading systems such as broker crossing networks. New safeguards being put in for high-frequency algorithmic trading activities. If first engaging in that trading, they have to be authorised, and high-frequency traders have to be properly supervised. There's new obligations to trade venues, including systems and controls obligations, circuit breakers, transparency requirements, and a requirement to publish annual data on execution policy. In terms of systematic internalizers, strict requirements, and a much wider definition of that entity, catching many more entities. There are wider pre- and post-transparency rules for trading venues, systematic internalizers, and investment firms. The equity market transparency requirements are now extended to equity-like transactions, and the new trading transparency regime for non-equity markets is being introduced, and that will include emission allowances. The extension of the transaction reporting requirements to all financial instruments to ensure that the MiFID II requirements mirror those of the market abuse regulations. We had the market abuse regulation coming in earlier, and the MiFID II requirements actually mirror that. We've got new supervisory powers to ban specific products or services or practices, whether they present specific threats to investor protection, financial stability or markets, and enhanced conduct of business requirements with additional protection for investors. And those contain restrictions on receiving fees, commissions, and non-monetary benefits, and called unbundling requirements. Previously, fees for execution, research, and so on were all bundled up and rolled up together with one price for them. Now they have to be itemised separately. So, looking at that briefly, the other people are going to be talking about this as well. The payments for the 2 is abolishing payments for research using dealing commission and unbundling research charges, so items have to be paid for separately. It's one of the most major changes under MiFID II. You can of course still pay for research, but there's lots of rules now attached to it. You can't accept it as a benefit. There's certain conditions are fulfilled. There's a quality enhancement test, and it has to be a minor non-monetary benefit. So you have to be able to show that it enhances the quality of the service to your client, and that it is actually an important part of the investment process. It has to be paid for out of the firm's own resources or paid for by the client. But if it's paid for by the client, it is subject to very strict conditions, including having to pay it out of a research payment account, having to set a research budget, and reporting back to clients on how the firm got value for money and how that enhanced the service for to the client. So quite a high barrier there. Why would anybody be concerned about an EU regulation if they're outside the EU? It's got a really far-reaching impact. Regulators right around the world are looking at this. The Australian regulators are looking at it, and certainly the regulators in the United States, including the SEC, have been looking at it, and I'll say something a bit more about that in a second. Because of the difficulty of complying with several sets of legislation in different jurisdictions, global investment houses are moving towards compliance worldwide. So we may see this coming, I think, as a form of international standard. But the key questions you need to be asking are, do you actually have analysts from EU houses? Do you have any EU investment If you can answer yes to one or both of those, you are going to have your investment research activities impacted by MiFID II. The US position is a particular one. The SEC regulations in the States require that any institution that sells research for hard dollars, as opposed to soft indirect payment through trading commissions, has to be a registered investment advisor. And that puts it very much in conflict with the position of MiFID II. So there's been a lot of debate about that, a lot of toing and froing as to what to do, because the market in the States and in the UK and in the EU particularly have been very worried about how they're going to actually be able to give and accept investment advice with this restriction. But the SEC has come back and has granted temporary relief to US banks and brokers, allowing them to comply with the requirements of MiFID II. It's called they call it a no-action relief, and that so-called no-action relief from the SEC allows US banks to accept direct payments for research without it being considered to be investment advice. However, there is a sting in the tail here. That relief only lasts for 30 months, starting with the MiFID implementation date of the 3rd of January 2018. So what will happen after that 30 months expires, we will have to wait and see. But I think they want to see, first of all, how that is bedding in and what the actual impact is on it before making a decision. So those are just my contact details in case you have any questions after this. But otherwise, I'm just going to hand over to Amber now. And there we are.
Thanks, Charlotte. And hi, everybody. I'm Fennell, partner and co-founder of Chilean Communications. Just a quick review of us. We are a leading specialist communications advisor in Europe, are fully focused just on healthcare, on all subsectors of healthcare. And we've been looking at MiFID II for a long time now in a series of newsletters, and we had a separate session on MiFID II. Things have moved on and have started to clarify, as Charlotte mentioned. The US now are going to allow equivalence on research. However, there is a lot of speculation, there is a lot of confusion. We are still to see a lot of things play out next year, but hopefully some of the ideas that we bring today will help you at least prepare for that and deal with that market is going to change in the future. Now, my focus is going to be on equities research, because that is, as Charlotte mentioned, one of the significant changes that are going to affect companies, listed companies, and to some extent private companies who are looking to become listed in the future. So the main difference for corporates next year will be that MiFID II will likely reduce the amount of research provided to fund managers. So previously the model, obviously the investors would get the research for free from hundreds of different banks, bombarded on a daily basis, followed up with calls from analysts, etc. And they would then decide what they invested in, and then banks were making the call that they would have commission from the trades generated from that interaction that would then pay for the research. For MiFID II, obviously, that stops. Fund managers will be paying for that research, and of course, the contents of that is that they're not going to pay everyone. They can't pay everyone, and they've got to also make the decision of whether they take on that cost themselves or whether they pass that on to their investors. And the majority now we're seeing of fund managers are saying that they will subsume that cost. In turn, it's much simpler for them, but obviously that will then reduce the amount of research they can consume, and if they reduce the amount of research they consume, we are going to see a reduction in the amount of research out there. So there'll be quite a lot of fee competition out there. The bulge brackets we're already seeing are being incredibly price savvy, with mooting their different offerings to the various funds out there. So the smaller institutions will find it much more difficult to be competitive and to maintain big research offerings. So I think that there will be fewer analysts. It won't be immediate. It will be potentially a gradual reduction, but the competition out there will be strong. So less research obviously means less coverage, and specifically, larger companies, the more popular investment ideas are going to, probably continue to see a good range of coverage from a range of institutions. The smaller ones, will they be affected as much? Probably, maybe not. Have their one broker and maybe some paid-for research, company-sponsored research, which is pretty much the norm for them now. But those medium-sized companies, that's where they're really going to see the squeeze, and potentially less analysts covering them, which obviously could endanger consensus on those stocks. We're also going to change, we suspect, on the type of research that will be out there. So reduction in this kind of care and maintenance or stock-specific research. With analysts knowing exactly who's paying and what they're interested in, that research is bound to be much more tailored. And the value, the customers will have to be saying, this is the value that I want generated, and they're going to be reluctant to pay for research that they don't see as valuable. The managers will demand more bang for their buck, so broader thematic work, which is cross-sector rather than just on individual companies, will be adding more value to them because they're looking at a range of stocks in a particular area. So again, the specific coverage on certain stocks will be reduced. And that traditional role of the sell-side analyst will likely change as well. Will they be dragged more into corporate finance situations, deal analysis, and they will have more different pressures than they had previously. And research on IPOs and secondary fundraisers and M&A, etc., is exempt from these regulations. So that won't change for a company considering an IPO. So the practical difference is in terms of investor access. So obviously, with the nature of broking support, it's likely to evolve. So not only will research have to be unbundled, but investor access will also have to be unbundled, and it will also have to be demonstrated that there's a transfer of value between a bank and an investor on corporate access. So fund managers are less likely probably to pay brokers for access, especially to companies that they already have invested in or know quite well. And the broker's ability to introduce corporate clients to new investors could become limited, because if there's no existing relationship there and no transfer value between the two, a new investor is unlikely to maybe one-off meeting and have to pay. They're more likely want to do it from their established provider. So again, that new investor situation is going to be tricky. Corporates will have to be much more self-sufficient in IR. So starting to look at how corporates will have to adapt in the future, they'll have to look at maybe maintaining their own consensus forecasts. Some investors may not have access to all the research out there and all the information out there. So companies will have to proactively manage and maintain their consensus forecasts. They'll have to conduct potentially their own share register analyses and start looking at targeting new investors, being much more proactive on organising roadshows and working on investor access. And there will be an increased demand on finance and IR functions. So really, it should be a kind of core focus of corporates looking at MiFID going forward to really bolster their internal processes, and also looking at ways they can use that, maybe using third-party providers. analysis of your news won't be as widespread. So another aspect is maybe to look at media relations, look at other ways, other tools of getting your message out there. Looking at company-sponsored research, it's always been, I think, an important function for smaller companies to look at using company-sponsored research, but I think that's going to increase as MiFID II comes into play. However, you know, the independent conflict issue is still there. They can't put a rating on those stocks, and obviously, if you're using a bank and paying a bank, there are all the legislative hoops to jump through that Charlotte mentioned. And banks' independence will obviously also be questioned. But the appetite for high-quality research will remain unchanged, and we're seeing a rise now of a lot of these research exchange and other platforms in which company research can be stored and reviewed. So that is another way of managing this change. And then moving forward to what really, and I don't want to take away from Liz's questions that she's going to ask later on, but some of the key issues really that should be discussed at board level is really, number one, talk to your broker. What model are they going to pursue? How will they support you in future? And are you ready? Is your IR function prepared? Have you got the IT systems for share register analysis, for example? Have you got an up-to-date investor database of all the contacts that you've made and relationships that you've had in previous roadshows, etc.? Receiving all your news, are you having regular contact with them? And your relationships with existing investors, what is your strategy for targeting new ones? It might be more of a mix, so using your broker, but maybe potentially also using a IR advisor as well. Do you need support? So do you need advice to help navigate? Do you need assistance with your share register analysis and augmentation? Do you need to work with someone who can give you a good market sounding board? As I mentioned, it's not going to all be sorted on January 3rd. There is going to be a process. We're going to see this play out next year. Things are going to change. Which investors are going to be rated by, which analysts are going to be rated by the investors is going to be critical. Who is actually doing deals with who has the best clients? Perception studies to again see how your story is playing in the market. How can you adapt it to potentially make it more appealing to certain investors? How can you use events such as capital markets days, R&D days, use investor conferences to get your message out there? As I mentioned, if you're doing a normal, regular financial update, at the moment you may have a raft of different analysts covering you and putting analysis on that news event. Under MiFID II, that might reduce, and you might have to then be much more proactive in getting that message out and that analysis out there. Do you need a Reuters or Bloomberg terminal? It's expensive, but it can be a fantastic tool in identifying your current shareholders and peer shareholders. Often, you know, your bankers will have access to that, but is it also something that you might want to bring in-house? Corporate access investor targeting specialists, as I've mentioned, using an IR agency. And then again, looking at sponsored research providers, could they help tell your story more to a broader audience? But again, thinking about how that balances with their integrity as well. And then just to mention before I finish, private companies, obviously, you know, from the get-go, it's not going to affect you, but when you're looking at doing a potential IPO, think the first thing to consider is the research provision when choosing a broker, and not only for that IPO, but for the long term. So you want to be choosing a broker who has those brilliant and best relationships, who's highly regarded in the market. Does a potential broker have the access and cover your peers? Your peer group is going to be important as well. And banks, just in general, probably to maintain their revenues, are going to be more likely to actually be interested in private business. And we've seen quite a few moves by Fennell, by Numis, by others, to really focus more on private business and assistance with private rounds. So again, even if you're not considering an IPO yet, having a conversation with a bank or a broker, if you're looking at financing, could be a good time to do so. So that's it from me. Again, please contact me if you want to talk further, but let's hand over for questions.
Thank you very much, Amber, and thank you, Charlotte. That was all very clear and very interesting, and I hope our listeners can see that there are some significant changes coming down the line, and not everything is fully thought out yet. It's going to be an interesting year as we get to grips with this. So at this point, I'd like to bring in Liz Klein, who is CEO of Klein Edmonds Associates and helps the BIA with our finance policy. And she worked as an analyst in a previous life as well. So Liz, do you have any reflections on that or any questions as we kick off? And hopefully our listeners will be thinking of what questions they'd like to ask and sending them in as we speak.
So I'll start with a reflection. As somebody who's nearly 20 years as a sell-side analyst, if I was still a sell-side analyst, I'd be rather concerned. Number one, where I wouldn't be able to continue to write any completely independent research because I would be unlikely to be paid for that unless I was one of the first top 2 or top 3 analysts that the fund managers were paying for. And many of the fund managers will be restricting their lists substantially to maybe 5, 6, maybe 15 firms that their fund managers can only pay for and purchase research from. So I would be spending a lot of time running after potential corporate brokerships or private companies that we can write on, but that would severely limit my ability to be independent. So the job will change. There'll also be substantially more competition with my brokership peers. So any of the other banks that will be working in the space, and I suspect they are going to end up in 3 or 4 years' time being far fewer brokers. But I'd be interested to know whether or not Charlotte or Amber have similar views about the changing role in the changing marketplace on brokers.
I agree. I think there will be far fewer. I think there will be far fewer brokers. I think a lot of people. I think the general feeling is to absorb the cost, and that will be a change. But I think the model is going to change completely. It's going to be a different job, and I think it's going to have a huge impact on the industry.
I agree. I mean, I think far fewer brokers is really the only way this can go. The fund managers have to be selective with the research that they consume, and they'll want to be as efficient with the cash that they're spending on it as possible. And as you say, they're going to, some investors, as we've heard, will choose 2 to 3, 4 to 5, or some banks are providing one thing buys you their entire research capability. However, they're going to have to make that very selective and make that quite streamlined to the customers that they have. So, as you say, the freedom to just initiate on some random stock that no one's heard of is probably going to be impacted. It may fall to some of those company-sponsored research houses to manage those, but again, their integrity is sometimes questioned. But yeah, we'll see. We'll see how it play out.
And I think whatever happens, whichever way it goes, I think the cost of compliance will increase, especially if houses do decide to run retail, research payment accounts and so on. There's a much higher bar there to compliance, and a lot more has to be done, which will be, well, I think they'll need to employ more people to do it. They will have to have more policies, so more expense in producing those, and just the simple cost of compliance and just running it.
So again, that will squeeze out the smaller player.
Yes, and I also think that a lot of those costs may well be passed on to the corporates that people are writing research on, because they would need, many of the corporates, some of the trends I've seen recently is to go for dual brokerships, to go for IR teams, additional lawyers, pay for research, and all those costs as a corporate will increase and in order to allow you to access the investors. So that's something I would suggest that many of you as management of companies will need to think about is what is your budget and where do you want to spend that?
And the cost of being a public company is definitely going to increase.
Yes.
Absolutely, but that also, the legislation, the cost of compliance with those smaller players is going to be quite significant. I think what has been quite clear and quite scary at the same time is that a lot of those smaller companies institutions haven't prepared for what's going to happen, haven't put their processes in place. There is a grace period from the 3rd of January. It's not the regulator understands that it's a tricky legislation to put in place, but these companies are going to.
I wouldn't say it was actually a grace period. They said that they understand the difficulties of implementation, and so they won't be too hard on people. The FCA is saying, provided that they can see that people have made reasonable attempts or reasonable endeavours to comply, and it's what the FCA thinks is reasonable endeavours rather than what the company or people themselves think are reasonable endeavours. And in other areas in my practice, we have seen many people coming very unstuck on the FCA thinking of what reasonable endeavours is really not what anyone else thinks it is.
So I think we've had a few questions in about which size broker houses will lose out most, and I think we've answered it there. Another question we've had is, what effect will the regulation have on the companies who aggregate and produce consensus forecasts from equity research, if any?
I think that the aggregators, there'll still be a role for the aggregators, but it will cost corporates. Corporates will need to pay for that instead of just getting it free from their brokers. It used to be, for many of those, would get that part of their relationship with their broker. They may well need to pay for it separately now. So there will be probably increased competition with those aggregators because everybody will be trying to go for it. But it also is an additional cost for the corporate possibly to take on. To some extent, we're using the words possibly and maybe, and our view is because there's no clarity on exactly what will happen with these issues, and that is something to discuss at the board on what the best guess is and what to do in different scenarios, especially around these costs.
And Amber and Charlotte, do you have any other key things that companies should be, management teams should be discussing with their board about MiFID II?
So I think the first thing is to, as we've seen, explain what MiFID II actually is. It's incredibly complex. I focused on the research element as the most significant part, but I think, sadly, a lot of like with the institutions, maybe being a bit slow to understand the real impact. A lot of companies have also been largely in the dark on how this is actually going to play out. So I think the best to do is first talk to your broker, talk to your advisors, and as I said, what model are they pursuing, and how did they foresee their support to you changing in the future? Liz touched on co-brokerships. We have seen quite a few companies go for that approach. However, I would also just see how things play out first. See how the market reacts. We may be in a very different world in 6-7 months, so perhaps wait before making call and but as I say, work with your IR function to make sure that you're prepared.
Yes, I agree with that, and also, yes, in terms of briefing the board, on many occasions to come in and brief boards on what the impact of this is going to be, depending on the type of company. But a question that usually comes up, which is related to it, which hasn't been asked yet, I think, as is what is going to be the impact of Brexit on MiFID II. Now, nobody actually really knows that at the moment. And on my way in here, I was sort of looking at the very depressing news on television about that. But we didn't really know. But MiFID II has been largely drafted by the UK. Been the FCA and Treasury have contributed to drafting of MiFID II. We're still in the EU, so we have to implement it, of course, which is why we're talking about it now. But it is something that the UK and the UK regulators are very keen on. We do like it. So I don't think it's going to go away anytime soon. And what I would anticipate is, in time to come, bits of MiFID II that perhaps we don't like or don't work well, we will get rid of. But I think it's a trend in the market, it's a worldwide trend, and it will be here to stay, I think.
Very interesting. Another question we've had in from one of our listeners is, are the additional costs likely to lead to fewer companies seeking an IPO in favour of funding, do you think?
Well, I think there's a lot more at stake than just the cost of an IPO to consider for a company. But of course, the burden of being a listed business is going to increase, and it will be more of a significant undertaking. So that will definitely factor into decisions. I wouldn't ever say it was the leading one, but certainly one that will factor in. And a company needs to be at a stage where they have that maturity, those processes in place to properly make the most of that listing.
And I think one of the things that appears to come out from some of the US comments that Charlotte may elaborate on further is that even if you go and list on NASDAQ, you're still going to be covered by a lot of these regulations or be impacted by a lot of these regulations if you have any European investors existing or future and any European relationships. So you don't surround it by just going to NASDAQ.
Absolutely, Liz. And I think the other point, as I mentioned in my presentation, is the fact that this is really a global trend, and a lot of the global houses are moving towards implementation just across the board, simply because it's going to make compliance easier.
So we've not got any more questions. Does anyone have anything they've not been able to bring up through the questions that they'd like to say?
I think I'd just like to reiterate that the most important thing to do is to engage with your board on these matters, and if you feel uncomfortable doing that or don't feel informed enough, asking somebody who is informed, a broker, your investor relations specialist or a lawyer, to come in and speak with your board and come up with a strategy and that can play out over the next year as the different rules come in.
Thank you, Liz. And thank you, Amber and Charlotte, for your very clear explanations today. It's been very interesting. Before we sign off, I'd like to flag a few more events and webinars coming up. We have our BIA Brexit briefing webinar on the 22nd of December, where you'll hear the latest in the BIA and maybe PI activity around Brexit. And then moving into the new year in January, we have a very busy day on the 25th of January with an event for investors at the London Stock Exchange, highlighting the investment opportunities of the UK life sciences sector. Then an afternoon event called Biotech in the City, where we'll be exploring finance data of this sector. And then finishing at the gala dinner, which is a great party. If you'd like to come along to that, you can register for all of those events, apart from the London Stock Exchange one, on our BIA events website. I'd also like to give a little plug for the BIA Finance and Tax Advisory Committee, which looks after all of our obviously tax and finance policy work. And if you're interested in getting involved in that and you're a BIA member, or if you'd like to join the BIA, do get in touch and we would be very happy to sign you up and get you involved in all of that. So thank you very much to everyone being involved. Thank you for listening and wish you a good day.